So how much should you expect to pay on this little beauty? This is in Bothell, Washington. If you don't know, this is a suburb of Seattle, very popular area to live in. You can see it's a 4-bedroom, 2-bath, about 2,000 square feet. It was built in 1980, beautifully updated, as you can see here, at least from the outside. And basically, we just want to answer today, what would you expect to pay, if you were to purchase this home? And we're going to look at 2 different scenarios. So we're going to look at 20% down, and we're going to look at 5% down. Now, in both of these scenarios, we're going to assume that you're a first-time home buyer and that you've got good credit, 740 credit score, and you're a first-time home buyer. So first, let's look at the 20% down scenario. Basically, right now, we're looking at 6.687 for, this is an interest rate with no points. Now, the APR is 6.721. If you want to know what APR is, or how reliable or useful it is as a disclosure, then you can find that in some of my other videos here. It's beyond the scope of this conversation. But those are the numbers that you're looking at here, 6.687. And so with a loan amount of $599,200 and a 6.687 note rate, your principal and interest component is going to be $3,861. Now, I pulled the real estate taxes on this particular property, and they were $495 a month. Of course, real estate taxes can change from year to year, but that's what they are right now. And then homeowners insurance. Homeowners insurance is something that I will just kind of use a rule of thumb, based upon the price of the home. $125 a month for this home is more than enough to get it insured. Now, you could pay more, you can pay less, but those are the numbers that you're looking at. And so you're looking at about all in of just under $4,500 a month. Income to qualify for this, debt to income ratio for conventional loan. Usually you have a hard cap of 50% of your gross monthly income. So you're going to need about $9,000 a month to qualify for this, assuming no other debt. Now, what if you put 5% down? Let's take a look at this over here. First off the bat, you can see here that your monthly payment's going to go up by almost, let's say, it's $500. It's going to go almost by $800 a month because you're putting a lot less down. Here your all-in cash is $160,000 to get this home, whereas with the 5% down, you're closer to $48,000. The interest rate here, the note rate is slightly smaller. That's somewhat of an anomaly. Usually the lower down payment means higher risk, means higher interest rates, but Fannie and Freddie made some adjustments to their tables lately, and so with a little more down, you actually have a slight improvement in rate, but then the APR is higher, and the reason for that is because you've got this, you got this mortgage insurance component here. Now, because you're a first-time home buyer, the loan pricing isn't significantly affected, the note rate, by credit scores or type of property or amount of down payment, but mortgage insurance will be impacted by credit scores particularly. So just keep that in mind. Keep your credit scores as good as they can be. And so now we've added this mortgage insurance component. Now you may be able to remove that in the future. That's never guaranteed. There is a point if you keep that loan long enough where it will drop off automatically. But you may be able to remove it sooner if you have enough appreciation or you pay the loan down enough. But you shouldn't go into this assuming that's going to happen because that's dependent on future events. But so you've got this mortgage insurance component, you've got $4,570, your principal and interest portion, taxes are the same, homeowners insurance is the same. So you're all in about $5,400. Now, obviously, we've made a lot of assumptions. I've tried to state some of those credit scores, first-time home buyer, what type of property it is, single family versus is it a condo or manufactured home. Your particular situation will vary depending on your specifics. And if, so you really should talk to a mortgage professional when you get into the market, you're ready to start shopping around, or even just start to kind of figure out what you can afford and what the payments would look like. Talk to a mortgage professional. Feel free to reach out to me. We're licensed in Washington and Idaho, but we have contacts all over the country. Happy to connect you with someone even if you're not in my market. Thanks so much.